Building $1 million portfolio sounds complicated, but Warren Buffett would tell you it's actually simple if you follow the right blueprint. Because wealth isn't built by chasing hot stocks or timing the market. It's built by understanding how money really grows over time and how to avoid the silent traps that keep most people from ever compounding their wealth. In today's video, Warren Buffett's $1 million blueprint, the portfolio anyone can build, will break down the 10 essential principles that turn small, consistent steps into long-term financial freedom. No guesswork, no hype, just timeless wisdom backed by data, discipline, and the same strategies Buffett has relied on for decades. By the end, you'll understand exactly where people go wrong and how a simple, boring, repeatable plan can build real wealth even if you're starting small. Let's begin with the biggest misconception about safe money. Number 10. Cash feels safe until it costs you. Cash doesn't crash, it erodes. Most people think holding cash is the safest financial move they can make. It feels secure, predictable, and risk-free. The money is right there, untouched. But Warren Buffett has warned for decades that cash is actually one of the most deceptive places to store your wealth. Because while cash doesn't crash like the stock market, it quietly loses value behind your back. Here's the problem. Inflation doesn't care how safe your savings account feels. When prices rise 3%, 5%, or even 7% per year, the real value of your cash drops even if the number in your bank app stays the same. You don't lose money. You simply wake up one day and realize your dollars buy less, your savings stretch less, and your financial future has silently been pushed further away. And when interest rates on savings accounts are low, which is what we've seen for most of the last 20 years, your money isn't growing fast enough to keep up with inflation. That gap is the hidden cost of playing it safe. Buffett calls it a guaranteed loss, steady, predictable, and invisible. Cash still has a role, emergency funds, short-term needs, but building long-term wealth with it? That's where most people fall behind without ever noticing. And if you think bonds or certificates of deposit fix the problem, well, they don't. In fact, they often fall into the same trap. We'll break that down in number 7. But first, let's look at why the stock market, despite all its chaos, has historically done something cash never will. Number 9. The stock market's long-term surprise. Stocks go up, crash, then go up more. For most people, the stock market feels unpredictable, a place where fortunes rise and fall overnight. But here's the surprise Warren Buffett has repeated for decades, despite the crashes, the corrections, the scary headlines, and the sudden dips. The long-term trend of the stock market is relentlessly upward. And it's not luck. It's math, productivity, and the engine of human progress. Over the last century, stocks have delivered some of the highest and most consistent returns available to everyday investors. Yes, they fall, sometimes sharply, but they also recover, and historically they recover stronger than before. That's because behind every stock is a real business, solving real problems, hiring real people, and growing real value. When businesses innovate and economies expand, long-term investors benefit. Meanwhile, cash sits still. It doesn't grow. It doesn't compound. And over time, it quietly loses value. So even when stocks look risky, they've historically outperformed cash by a wide margin simply because they participate in global growth, while cash does not. But here's the twist Buffett wants you to understand. The stock market's success is not about avoiding downturns. It's about outlasting them. People think they lose money because the market is volatile. In reality, most people lose money because they panic early, sell low, or never invest enough to begin with. And yet, even knowing all this, most investors still fear volatility more than they fear losing purchasing power. That's where number 8 comes in. Because volatility, it's not really the enemy at all. Number 8. Inflation is your silent enemy. What price did you pay for safety? For most people, leaving money in cash feels responsible, even smart. It feels safe, stable, predictable. But here's the uncomfortable truth. Warren Buffett has repeated for decades, inflation is the tax you never voted for, and it quietly punishes anyone who keeps too much money sitting still. Every year, the price of groceries, rent, healthcare, transportation, and almost everything else creeps upward. Even at a low inflation rate of 3%, your purchasing power is quietly slipping through your fingers. $100 today buys only $97 of value next year, and even less the year after that. Over a decade, that same safe money can lose over a quarter of its strength without you realizing it. And the danger is almost invisible. There's no crash, no headline, no panic. Your bank balance stays the same, But what that money can buy slowly dissolves. That's why Buffett calls inflation a silent enemy. Unlike a market dip, inflation doesn't scare you into action. It lulls you into complacency. It convinces you that doing nothing is the safer choice, while quietly draining your wealth from the inside out. This is why every long-term investor eventually realizes the real risk isn't losing money in the market, it's losing purchasing power by staying out of it. Sitting on cash might feel like protection, but in reality, you're paying a hidden price for that feeling. And this brings us directly to number 7, where we expose the real cost of playing it safe, and how that mindset can quietly sabotage your future wealth. Number 7, why bonds cash doesn't solve the problem. Bonds don't bloom either. For decades, people treated bonds like the grown-up version of cash, the responsible choice. You don't get rich, but at least you don't lose money, right? Well, not exactly. Because in the modern economy, bonds have a quiet flaw that most investors never consider. They grow too slowly to protect you from the world changing around you. Here's the uncomfortable truth. A bond paying you 2 to 4% sounds fine, until inflation quietly climbs to 3 to 5%. Suddenly, your safe investment is losing purchasing power every single year. It's safety on paper, but erosion in real life. And this problem becomes even more dangerous when you combine bonds with large amounts of cash. Cash sits still. Bonds crawl forward. Meanwhile, the cost of living marches ahead at full speed. This is why Warren Buffett has repeatedly warned that low-yield assets can be far riskier than they appear. Not because you'll lose dollars, but because you'll lose what those dollars can buy. A portfolio built on cash and bonds alone is like walking up a downward-moving escalator. You're working, but you're not getting ahead. And here's the key insight. Bonds can play a role, but only as part of a broader engine of growth. They stabilize, but they don't multiply. They protect, but they don't create. Because the real solution isn't choosing between safety or growth, it's learning how to blend them intelligently. And that takes us directly into something far more powerful, true diversification. See exactly how that works at number 6. Number 6. Volatility isn't the enemy, time is. A market crash isn't fatal, bad timing is. Volatility is the part of investing everyone fears. The headlines, the sudden drops, the red charts, they trigger an instinct that tells you to run. But Warren Buffett has repeated the same idea for decades. Volatility is not the enemy. In fact, it's a normal part of a market that grows over time. The real threat to your wealth isn't the ups and downs. It's stepping in and out at the wrong moments. Here's the truth. Most new investors never hear. Historically, every major market crash has eventually been followed by a recovery, and then new highs. Not sometimes, every time. The people who build long-term wealth are not the ones who avoid volatility. They're the ones who learn to sit through it. Because while the market tests your patience in the short run, it rewards your discipline in the long run. Think about it like planting a tree. If you pull it out of the ground every time a storm comes, it will never grow roots. Your portfolio works the same way. Time in the market allows compounding to work, dividends to reinvest, and growth to accumulate in ways that short-term trading can never replace. Most investors lose money not because they chose the wrong investments, but because they chose the wrong timing. They sell low, buy high, and repeat the cycle. But the investors who stay invested, even through the chaos, consistently outperform those who try to outsmart the market. And that long-term advantage becomes explosive once you unlock the force behind real wealth building, the engine that turns years into money compounding. That's coming up next in number 5. Number 5. Compound interest, wealth's silent engine. Your money must work, not just sit. When Warren Buffett talks about wealth, he rarely starts with stock picks or market predictions. He starts with time, because time is the force that turns small, consistent actions into life-changing outcomes. And the engine behind that transformation is compound interest, the quiet multiplier that most people underestimate until it's too late. Think of compounding as growth stacked on top of growth. Not only does your money earn returns, but your returns start earning returns, snowballing year after year. It's the financial equivalent of planting a single seed and watching it grow into an entire orchard, slowly at first, then suddenly, it becomes unstoppable. Let's make it real. If you invest just $300 a month at a modest 8% annual return, you don't end up with a few $1,000s. After 30 years, you end up with over $400,000, even though you only contributed $108,000. That extra $292,000, that's compounding, doing the heavy lifting. And it works even better when you reinvest dividends. Those small quarterly payouts are like fertilizer for your financial garden, accelerating growth in ways most people miss because they're focused only on price charts. But here's the part most investors never hear. Compounding only works if you stay invested. Jumping in and out of the market breaks the engine before it ever has a chance to build momentum. And that discipline, the ability to stay consistent, especially when the market gets loud, takes us directly to number 4, where we tackle the myth of timing the market and why it destroys more wealth than it creates. Number 4, diversified growth. Not all eggs in one basket. Don't bet everything on one horse. Many investors fall into the trap of putting all their money into a single stock, a single sector, or even a single country's market. The problem? What goes up fast can also fall fast, and relying on one winning horse can be catastrophic if the tide turns. Diversification is the antidote. By spreading your investments across different asset classes, sectors, and geographies, you reduce risk without sacrificing growth. Think of it like a balanced diet. Just as you need protein, vegetables, and healthy fats for long-term health, your portfolio needs a blend of equities, bonds, and perhaps even international exposure. No single ingredient can sustain you alone. For example, the S&P 500 represents a mix of 500 of America's largest companies. Adding international stocks gives you access to fast-growing economies abroad. Maybe you include a small allocation in bonds to temper volatility. The goal isn't to eliminate risk, that's impossible, but to manage it intelligently while letting your money grow steadily. History shows diversified portfolios weather storms better than concentrated bets. During market downturns, some sectors fall while others rise or remain stable. Over time, this strategy smooths returns, giving compounding the space to work its magic. Diversification also reduces stress. You don't have to obsessively monitor a single stock or panic when one company dips. Your portfolio is built to endure ups and downs. Up next, number 3, time in market beats, trying to predict it, where we uncover why staying invested consistently beats chasing perfect timing. This principle turns patience and discipline into real, long-term wealth. Number 3, time in market beats trying to predict it. You can't time luck. Most people believe that if they can predict the market's next move, they'll win big. The truth, even professionals with decades of experience often fail to time markets consistently. Trying to jump in and out of stocks based on headlines, fear, or hype is more likely to cost you than earn you. Historical data tells a different story. Over the last 50 years, the S&P 500 has had multiple crashes in 1987, 2000, 2008, and even 2020. Each time, the market eventually recovered, often reaching new all-time highs. Investors who panicked and sold at the bottom missed those rebounds. But those who stayed invested, even during downturns, not only recovered but benefited from the compounding growth of dividends and reinvested gains. Here's the lesson. It's not about catching the top or avoiding the bottom. Wealth grows from time in the market, not timing the market. Imagine planting a tree. You could water it sporadically when you feel like it, or you could nurture it consistently over the years. Only the second approach yields a strong, fruitful tree. Investing works the same way. Regular, steady participation builds wealth far more reliably than trying to predict each twist and turn. Relying on luck or intuition creates unnecessary stress and often leads to mistakes. But by committing to staying invested through highs and lows, you allow the market's long-term growth to work for you. Next, we'll cover a strategy that removes emotion entirely, making it almost automatic to harness this long-term growth. Stay tuned for number 2, automatic investing, your future self's superpower. Number 2, automatic investing, your future self's superpower. Set and forget. Most people think investing is about timing the market, checking charts, or chasing the latest hot stock. That approach is stressful, exhausting, and often costly. The better strategy? Automatic investing, letting your future self work for you while removing emotion and guesswork from the equation. This is where dollar-cost averaging comes in. By investing a fixed amount regularly, every week or month, you buy more shares when prices are low and fewer when prices are high. Over time, this smooths out volatility and prevents panic-driven mistakes. Imagine planting seeds in a garden. You don't wait for the perfect day to plant them all. You sow consistently, and eventually, a strong harvest grows. Investing works the same way. Automatic investing also builds discipline. You no longer need to rely on motivation or timing. The habit is built into your routine. Whether the market is soaring or plunging, your plan continues uninterrupted. Those small, consistent contributions compound quietly, often surprising investors years later with how much they've accumulated. Even modest amounts can grow into significant wealth if you start early and stay consistent. The power isn't in luck or market predictions. It's in consistency, time, and compounding. By embracing automatic investing, you remove fear and procrastination from your wealth-building journey. Your future self will thank you for the steady, disciplined habit you set today. Up next, number 1. View money as seeds, not as coins to hoard. The mindset shift that turns disciplined investing into long-term wealth. Number 1. View money as seeds, not as coins to hoard. Money is a seed, not a safe. For decades, most people have been taught to save money as if stuffing it into a vault guarantees security. But hoarding cash, even in banks or so-called safe accounts, often means watching it slowly lose value to inflation while missing out on growth opportunities. The real secret to wealth? Seeing money as seeds to plant, nurture, and grow over time. Think about it. A single dollar in your wallet doesn't multiply. But a dollar invested wisely, in diversified stocks, index funds, or even compounding savings, can sprout into far more over years or decades. Each contribution you make, no matter how small, is a seed. Over time, with patience, discipline, and reinvestment, those seeds grow into a forest of financial security. This mindset shift changes everything. Instead of fearing risk, you focus on growth, opportunity, and the long-term picture. You stop asking, how can I protect my money, and start asking, how can I make my money work for me? It's not just about numbers on a screen, it's about creating freedom and options. Planting seeds means taking action today that your future self will benefit from tomorrow, next year, and decades later. Hoarding coins only keeps you trapped in the same financial cycle. Your wealth grows not from luck, but from consistent action and smart planting. The sooner you start, the more time those seeds have to mature. Remember, real wealth comes from growth, not just preservation. Treat your money like seeds, plant them, nurture them, and watch your financial forest flourish. Building wealth isn't about luck or chasing the next hot stock. It's about consistent action, smart habits, and a long-term mindset. From understanding the hidden cost of cash to embracing stocks, compounding, diversification, and automatic investing, each step builds on the last. The real shift comes when you see money as seeds to plant, not coins to hoard. Patience, discipline, and time are your greatest allies. Start small, stay consistent, and let growth work quietly in the background. Your future self will thank you. Plant the seeds today, nurture them wisely, and watch decades of compounding transform your financial life. Practical takeaway. Begin automatic, diversified investing now. Even modest contributions grow massively over time. Comment below your first step toward planting your financial seed.